Hi, my name is John Jagerson and welcome to this introduction to technical analysis from Alpari. Technical analysis is really not very complicated. There are really just a couple of things to keep in mind, and then the rest is a matter of getting a little bit of experience. Now what I'm going to do is introduce to you a couple of the basic principles behind some of the most elementary technical analysis out there that, although it's where technicians tend to start out, it's where a lot of them stay for the rest of their career as one of the most effective ways to analyze the market from a charting perspective rather than from a fundamentals perspective. So there are really three principles that we have to keep in mind. Technical analysis is a study of price movements. So as an exchange rate changes, as these Forex pairs move up or down, we're looking at that price movement. What are those price changes? We look at those price changes over time. So really these two things largely summarize a lot of the information that we get about what's going on in the Forex. And then oftentimes, especially when you're doing intermarket analysis, we look at volume. That means how much trading is going on. We may be looking at the actual quantity of trades that are going through, as well as just looking at the volume of news stories, the volume of attention that's being paid to a particular exchange rate as it moves over time. Now, we're going to be looking at technical analysis from the perspective of chart patterns. So these are price patterns. They typically fall into basically two categories. The first category are continuation patterns. Now, continuation patterns are very common, and typically they're short-term in nature, meaning that they appear, they don't take very long to appear, and they don't typically take very long to present a breakout signal or a trading signal of some kind. Now, technical patterns that fall into this category of continuation, probably the most common type is some kind of a triangle. Now, oftentimes you'll see technicians talk about this as wedges, pennants, triangles themselves. There are flat bottom triangles, there are flat topped triangles. There's a number of different variations of what these things look like. There's a wedge, for example. We've got flat top triangles, and in each case, here's what's going on. There was a prevailing trend that was in play. So let's say, for example, we'll take this flat top triangle as a good example. There was a prevailing trend in prices as it started to, in this case, move up. And then we get a little bit of a correction, not uncommon. We get another little move up to the top, same point that it was before, or in line with that trend line. And then we start to move down, and you can see the pattern emerge. What's really happening here is that we get this tightening of the price range. So what was a trend is now turning into a very tight trading range. This is classic. This is exactly what we're looking for as technicians. And the little nuances like this, is it symmetrical? Is it a rising wedge like this one is? Is it a falling wedge? Those are not as important as just the principle of there's this tightening range. It's a consolidation. So what we're looking for amongst consolidations or continuations is a breakout to the upside or in the direction of the previous trend. Now, if we had used in our example a downward trend, so for example here with our little rising wedge, what if we had a downward trend and then prices started to consolidate in a tighter range against that downward trend? Well, we'd be looking for a breakout to the downside. So you can see essentially what a consolidation pattern is we're looking for a continuation to the previous trend. We know that the market doesn't like to move in a very tight range. There's a certain level of volatility amongst all the capital markets, and the Forex is no exception. And so looking for that breakout, that buying opportunity, is really what we're after. Here's a classic example. Now in this Forex pair, we had this nice prevailing upward trend. We start to consolidate, and you'll notice that these tops and bottoms are getting closer and closer to each other until finally we pop out up above that upper trend line in the triangle, and boom, there's our buying opportunity. These are some of the things we look for, and it really doesn't matter your time frame. If you're trading off the daily chart, such as in the example that I just showed, that was a daily chart. It was a chart with daily periods. Or if you're trading on the very short term, so hourly charts, it works largely the same. Really, the only things you're concerned about at that point are trading costs, which are going to be different depending on how frequently you trade and how large are your profit targets or stop losses, those sorts of things. Now, there's another type of technical pattern that we're very concerned about. Continuations are the most common. You'll see them most often. You'll hear traders talking about them constantly. The second style are reversal patterns. Reversals are what they sound like. So instead of a continuation, they're a change in the trend. Now these are more rare, but they're very important from a couple of perspectives. Number one, reversal patterns predict not just a trading opportunity like we talked about here with a continuation pattern, but they alert us to a period of time when risk is elevated. And I have a very specific example, but I'm going to show you a couple of very common versions of reversal patterns. Here's one. Let's say that prices have started to rise and we get a little bit of a correction. Subsequently, they rise to a higher top. So we're not looking so far, we're not looking like this is a continuation pattern. We rise to a higher top. Again, we correct down to maybe approximately the same level as the previous correction. And we pop up again to another lower top. And then we get back down again to this same level. This is called a head and shoulders pattern. You'll notice that if we imagine there's a little head right there and shoulder one, shoulder two, this is a very important pattern. In fact, this is one that, although rare, is something that traders look for on a regular basis, and when it appears, it generally represents very significant opportunity, as well as a big red flag that the prevailing trend, which in this case was to the upside, is probably in danger. Here's a specific example of what this looks like. Now this is on a very long-term chart, and what I'm trying to do is to illustrate that technical analysis is largely independent of time frame. So you can see head and shoulders tops, that's what we would call this, on a weekly chart, and that's what I'm showing, which would have been a big alert right now that there was an opportunity for not only downside plays, but for anybody who was long this particular pair, that long trend was at risk and definitely a very high probability of changing. So that changes the way we manage our risk. At the same time, reversal patterns can be applied to a very short-term chart. You could look for head and shoulders tops on a 5-minute chart if you're willing to sustain that kind of market volatility and those kinds of trading costs. So it's largely independent of time frame. Here I'm looking at it on a weekly chart, but you can just as easily find these on a 5-minute chart or an hourly chart or whatever your trading preference really is. Here's another example of a reversal pattern, another one very common. Prices going up, we come down and correct, kind of looking like one of these head and shoulders patterns, but then we pop back up to basically the same level we were before and right back down again. So we're in this little channel where it's not looking like a continuation pattern where we get into this tighter and tighter range. It's more or less square. We've got these two tops. We start to look at this. This is a double top, by the way. And a double top, we start to look for the breakout to the downside. When that happens, this is a great opportunity for shorts to get in the market, but it's also a big warning sign for longer-term long positions to start unwinding or at least protecting their trades. These are the ways that we'll use technical analysis, is not just to find the opportunity, but to manage our risk in the opportunities that we're already in. Now, by the way, here's a little tip for you. This is just an introduction to the concepts of price patterns, but what you'll find is that you can invert them. So you can look for the same way we looked at continuations, where we were saying, well, it largely doesn't really matter very much what the triangle looks like. What really matters is the narrowing range. Doesn't matter if the prevailing trend used to be down, you look for a downward trend to continue. If the prevailing trend was up, you look for the uptrend to continue. Well, the same thing in concept here with reversal patterns, in that if we inverted this head and shoulders top and it started looking like this, we've got a head and shoulders bottom. So this is it's the same thing with a double bottom down here. We'd be looking for the same kinds of opportunities just to the other side of the market. So these things are, once you've learned the concept, you can start to apply them regardless of what the overall market sentiment is like, or what your market conditions are like. The principles are essentially the same.
This video has been brought to you by Alpari.